Financial statements play a key role in analyzing and valuing a company. The objective of FSA is to assess whether the market is over or undervaluing a firm's shares. Today we'll be covering the 6-step analytical framework to assist in this valuation. Those 6 steps are as follows. You identify industry economic characteristics, identify company strategies, assess the quality of financial statements, we'll analyze profitability and risk, we'll then prepare forecasted financial statements, and finally we'll value the firm. In step 1, we identify industry economic characteristics. Competitive dynamics of an industry play a pivotal role in influencing strategies. In looking at this example, we are looking at 3 different industries that have drastically different compositions. We have a grocery store, we have a pharmaceutical company, and we have an electric company. Obviously, these industries have different operating capacities, and their financial makeups will reflect just that. Most grocery store chains aren't going to be dramatically different from one to another. For example, Kroger, Walmart, and H-E-B's products are fairly interchangeable, despite how strongly a Texan will disagree with you. And the barriers to entry are pretty low. All you really need is a place to do business and access to a distributor. These 2 factors mean that profitability will generally be depressed. Pharmaceutical companies have a much higher barrier to entry due to investments in technology, research, and development. These high barriers, along with patents and exclusive rights, drive profitability for better margins. So you'll generally see higher net income ratios as compared to our previous example of the grocery store. Utility companies are capital asset intensive, so you'll generally see large amounts of PP&E, property, plant, and equipment on the balance sheet. Electric companies have generally realized high profit margins because government regulators permitted monopolistic competition and they set the rates that they could charge. There are various tools for studying industry economics, and the ones that we'll focus on is going to be Porter's 5-force framework. This framework identifies 5 forces that influence competition and profitability in an industry. First, we'll start out with rivalry amongst the firms. Are there a limited number of firms competing in the same industry, or is it a free-for-all? There are threat of entrance. How hard is it to compete or get into the industry? Are we talking capital investments, technological experience, patents, etc.? Threat of substitutes. Are your products or services easily replaced or interchangeable with your competitors? Buyer power. Are the buyers price takers or are they price setters? How many buyers and sellers are there in a specific market? For example, Walmart being a buyer has significantly more power than an individual at a grocery store. And then finally, supplier power. Are there a large number of suppliers meeting demand or a very limited number? For example, suppliers of computer chips generally have a lot of power because they're limited in numbers and alternatives aren't generally available. In step 2, we identify company strategies. The framework for strategy analysis includes the nature of product or services. Are they creating unique products or services or generic replacements? The degree of integration in the value chain. Are you developing everything in-house or are you outsourcing various elements? Degree of geographical diversification. Is the firm targeting specific geographical areas such as your town, your state, maybe your region, a domestic market, or various countries around the world? The degree of industry diversification. Is the firm a diverse conglomerate or is it operating in a single industry? Step 3, assess the quality of the financial statements. Accounting information should be a fair and complete representation of the firm's performance, their position, and risk, and it should provide enough information to forecast future earnings and cash flows. The accounting information would include the financial statements along with the statement of comprehensive income, statement of shareholders' equity, and the notes to the financial statement. Just because a company is listed on a stock exchange and has been audited by a public accounting firm, that doesn't mean that the financial statements are a fair and accurate representation of the firm's performance. In step 4, we analyze profitability and risk, and the tools we use for this include common size financial statements. These are helpful in comparing firms of various sizes. The balance sheet is represented as a percentage of assets, and the income statement is represented as a percentage of revenues. Looking at the financial statements as percentages as opposed to dollars really helps in digesting the differences between the companies and industries, just like we did in the grocery store, pharmaceutical, and electric company example earlier. Percentage change in the financial statements. These are helpful in highlighting changes in the statements over a period of time. You'll often hear delta or MOM, which is month over month change, which is just a means for tracking changes month to month, year to year, or any other time comparison. And finally, financial statement ratios. These express relations among various items from the financial statements. There are a ton of ratios that you could run to incorporate expenses, debt, assets, shareholders' equity. You name it, there's probably a ratio out there, and these ratios can be used as indicators of future performance. Step 5 is where we prepare forecasted financial statements and then we value the firm in step 6. Obviously, all 6 steps in this framework are important and they all relate to each other in some way, but the critical and most difficult step is forecasting future performance in terms of financial statements. The reason this is difficult is because we are relying on an assumption about future business activities for which we may not have a ton of control over. Strategies, leadership, regulation, competition, inflation, you name it. They all change and evolve over time, some quickly, some not so much. The reason that we've gone through these 6 steps and analyzed a company's industry, their strategy, their accounting quality, and financial statement ratios is to gather as much information as we can to develop forecasts for future performance. Once we have a forecast of what we think, and I stress what we think is going to happen, we can value the firm. Most capital market investors value the company based on future dividends, earnings, and cash flows to determine if the security is currently over or underpriced to help aid in their decision of whether they should invest or not. Thanks for watching, and I'll see you in the next installment.